And we're live.
All right. Hey, everyone, and welcome. My name is Scott Cohen from AGP Ventures in Boston, along with David Yahid, based in Renana, Israel. Welcome to our latest edition of AGP Access, which is our series aimed at connecting Israeli entrepreneurs and founders to the U.S. market. And special thanks to our co-hosts, Mass Challenge and Lion Run Consulting, full-service startup studio that helps companies around the world raise capital. So look, just by way of introduction, if you don't know AGP Ventures, we're an early stage venture capital firm that invests exclusively in Israeli startups. We're based in Boston and Tel Aviv. And our mission really is to connect Israeli founders to the US market, both through our venture investing and through our commercial go-to-market division, AGP Access, which is actually run by David, who's on the call. So one of the many ways we try to help Israeli founders is through interactive forums like this, where you can meet and can interact with current and former executives at the Fortune 1000. We've hosted live streams with executives from companies like Apple and Amazon and Facebook, Walmart, Uber, Fidelity, the NFL, Wayfair, United Health Group, and many others. And we are just honored to have with us today Gene Hahn, who's the founder and principal of Halo Advisory Network, which coaches startups and advises VC firms like ours. So I met Gene probably a decade ago when he was kind of doing very cool and disruptive things at Target. He held a bunch of titles there, VP of Strategy and Innovation and New Ventures and a bunch of others. He's got just incredible insights on building startups, working with corporates, raising money, and we're really just thrilled to have him join us today. So, Gene, great to see you again and welcome.
Oh, thanks for having me, Scott. Great to be here. Yeah, looking forward to this.
Yeah, so folks, like we run a very informal shop here. So Gene's going to run through some slides and provide some insights, and then we'll open it up to Q&A. You can ask those through the chat function here, or just text us if you're part of our WhatsApp founders group, and we'll do our best to get your questions posed. And so if you see me looking down, it just means I'm checking your questions. So Gene, why don't I hand this over to you and we can get rolling.
Sure. Hey, great to be here. Looking forward to this. And again, let's make this a conversation. I did prepare some content. And David, I don't know if you can enable the screen share here.
Yeah, pulling it up.
You know, as Scott mentioned, a little bit about my background. Spent a bunch of time in retail. Was head of corporate strategy, ran the innovation, helped build the innovation team, was running the partnership with Google, MIT Media Lab, but also ran about 6 different accelerator programs, including the one with Techstars, and then moved on into Venture Studio to help work on B2B SaaS outside of the retail space, a lot of fintech, healthcare, some ag tech as well. I'm currently an LP in a fund, as well as an advisor to a couple of venture studios, as well as VC firms, as Scott mentioned. Cool. You know what? I thought I'd start off my conversation today talking about this, and I don't know if everyone's seen this. This is what's called the startup ladder. And there's a couple of different rungs. And the reality is that founders kind of start in the execution rung, if you will. You know, you start building something cool, kind of get a good idea, what have you. And then you quickly start looking for cash. And then you look to add some people. And then what ends up ultimately happening is that you need to sharpen your strategy in terms of how you're going to build this company and go to market. And that's a little bit of the framework for today's conversation. I know we've got a range of startups from earlier stage to later stage, but I want to go bottoms up and try to give you a couple insights of things I've learned in the last decade across each one, including some fundraising tips, maybe some dirty secrets. Working with corporates, we'll talk a little bit about working with boards too, creating a foundational growth strategy and what really is strategy. You know, my transition into tech and startups, people are like, strategy, what's that? And then finally, bringing it all together with a little bit of startup leadership here. Okay, cool. Okay, and the fundraising tips, you know, the first rung here is cash. So you built something, you're looking for money. I want to take a step back really quick and talk about early stage investors. And here's a spectrum from early to kind of later stage. When you're pitching in the beginning, obviously, you know, you're getting the investment off a team, but it's really important to do the rigor, right? Especially when you don't have the results yet, and build conviction through your story. All right, I bring that up because I think sometimes startup founders forget that conviction piece. There's a lot of storytelling that's incredibly important. And then as you move forward, what's really important? Results, KPIs, foundational progress, having trajectory. But the other thing too is that you really want to start thinking about building distinctive assets. Why do I bring this up? Because what I've seen in the market, earlier stage companies are building a little bit more, and they're showing more KPIs as they go for the first tranche from that standpoint. Okay. So kind of inside tip number one, I was working with a Series A founder, and we were just catching up, and he said he's like, yeah, I'm gonna go meet a bunch of investors, and I was, well, your fundraising is not gonna start for another month. He's like, well, I'm gonna soft start and start fishing. I was like, oh, tell me more. All right. And the soft start is really just getting going before you officially fundraise. And it's a way to compress your fundraising timeline by figuring out like who's investing, who's potentially an investor, and also get some feedback. So a great way to do this, the soft start, line up some meetings, ask for feedback on your pitch. Okay. This is what I would call fishing. And they're going to tell you what they think about the idea. And by the way, if they're interested, they're going to tell you that they're interested. Hey, when you start, let's talk. I'd be interested in getting into the round. The other good thing here is also it's a good time to get a read on the market, gauge market interest, as well as identify new potential investors. So some of the founders that do a fundraise and get through this really fast process have done this pretty actively for a couple months even before they've started from that standpoint. Cool. Okay, number two, kind of a little bit of question, pitch deck goal. This gets a little bit confused for some folks, but what's the real goal of a pitch deck? Any initial thoughts? Okay. The real goal of a pitch deck is actually to get you a meeting. All right. The pitch deck is a marketing document that enables you to get a meeting in front of the investors so then you can make a concise and compelling story and help build conviction around your idea. All right. I think a lot of folks, sometimes some founders, I would say overthink the pitch deck, but load it up with so much information that they're looking for the investor to make a decision by looking at the pitch deck. And that's actually not the best approach. Well, you can do that, and you definitely want a pitch deck that has the right numbers, the right KPIs, and all the facts. Okay. You really want to think about your pitch deck is to create enough interest to have the investor, okay, or someone in the firm meet you where you can tell them your story firsthand and give them all the color commentary and the context and the anecdotes that really your concept warrants from that standpoint.
So, Jane, a question about that. So when you're cold pitching an investor, would you suggest sending a pitch deck or a one-pager?
You can do either. If your pitch deck is short, you can send it ahead. I recommend pitch decks off the 20 pages if you do a send ahead. Otherwise, a one pager will work as long as it's really effective and gets enough of the information over from that standpoint.
Right.
Okay, cool. Later this stage, company are the more proof you need in the concept. Don't get me wrong. When you're an early stage company, you need to make sure you have your math done, the rigor. Okay. All right. It means you've done your research, you have the right facts, you really understand the market and the opportunity there. But I just wanted to highlight that piece around the pitch deck goal. It is a marketing tool first and foremost, and then get in front of the founders. They're going to ask questions. They're going to do due diligence. They're going to go to your data room. That's going to influence the decision, right? Okay. Another flag on equity. There's been a couple startups I've worked with where, the founding team has maybe had someone leave pretty early on. So one thing to be aware of is an early red flag around equity when you have some zombie equity. And what is that? That is essentially equity that's dead on the cap table that doesn't work for you. Okay. And that the classic case is you have a co-founder, they decided to leave, they have some equity, a fair amount, in fact. Okay, that equity is no longer working for the company. All right. And it's something to be prepared to speak to and make sure they have a good explanation there. Remember, equity is a very powerful tool, and it's a very powerful incentive that helps align motivations and gets people aligned pretty quickly from that standpoint. Okay. Okay. So fundraising tips, just a little recap. Start before you officially start, do some fishing. Remember the pitch, the goal of the pitch deck, and then be mindful of zombie equity from that standpoint. A couple other things. If you're an early stage startup, if you're sending a one-page teaser, that's fine. Some of the decks can be quite big, like file size. Use DocSend when you can. Don't jump up inboxes. That just drives VCs nuts, investors nuts. If you have multiple people on the call, okay, let's say you have your CTO or another co-founder. Don't talk over your team. Make sure when they're there, they the technical person is answering the technical questions from that standpoint. Okay, it is a red flag, and it's something to be mindful of. And then finally, try to control the next meeting. This is just good hygiene and business development. Set the next meeting. What does that look like? And if they say they're going to follow up and they don't, make sure you follow up with them after a certain amount of time, and then understand their investment process. What does that look like? What's the IC or investment committee look like, and how often do they meet? And just recognizing that piece. Okay, it's a little bit on the first rung on the ladder here. Okay, rung number 2, a little bit about execution. Probably the thing I get tapped initially the most. Okay, working with corporate. So, who's done a corporate pilot? People that have done a corporate pilot. Okay, a lot of people like to do corporate pilots. I'll give you some inside tips on the corporate pilot piece. Okay, first is a reminder in corporate context. So decisions move slower than you expect. And the why behind this is that calendars, the more senior you go, are usually very full. Okay, it was pretty common when I was heading up new ventures at Target. Startups would want to meet the next week, and my calendar was probably booked up for 6 weeks at a minimum with my assistant. All right, and so just remember the calendars are full, and so when things move slow, that's usually one of the big drivers. The second thing is that decisions are usually made by committee. All right. Usually it's not one decision maker, but there is usually one person influencing the majority of the decision, to be clear. But oftentimes those decisions also need to be socialized. That means there are other people, quote unquote, that need to know what's going on. So it's not a surprise. All right. And so that's usually the process from that standpoint. Here's the one insight a lot of people kind of have, like, who am I talking to in the organization? Not uncommon for you to come across as what I call a corporate trio or corporate tripod for a pilot. All right. There usually will be, you might go in through the innovation or tech liaison. You know, in my old world, yes, we were the team that would engage with emerging startups, right? Kind of feel that. Very quickly, you'll probably get handed off to a business lead who's kind of your actual go-to person, all right? That person, that business lead, will actually be the person you probably get the most work done with. But the other person you want to be mindful of is the business sponsor, the person that actually has the most influence or impact regarding your technology or your company that's going to impact their P&L or business, all right? So how do you work with these folks? Listen, the innovation tech liaison typically is an awesome navigator. They know how to navigate the org, who's who, how decisions are made. Okay, they also, a lot of cases, influence the business case pretty big. The business lead is typically your biggest Sherpa or person you're going to be working with day to day on the pilot, and actually helps you get the most done. But be mindful that the business sponsor is the one that probably makes the ultimate decision. And in some cases, the business sponsor trusts the business lead so much, they'll look to them to actually help influence the decision, a majority of the decision from that standpoint. Okay, good. All right, the other thing to watch out for, and I saw this a little bit more when I was on the venture studio side, all right? And honestly, I was probably the culprit on the corporate side. But watch out for non-starter friendly terms, all right? Typical large companies that specifically are not used to working with the early stage companies, they'll have some what might feel like deal breaker terms. And these could look like commercial payment terms, insurance requirements, or even IP rights out of the pilot. Make sure you take a look at those. Okay, specific to insurance requirements, I can tell you when I was in the venture studio, we're doing a lot of B2B SaaS. Cyber insurance requirements were coming up quite a bit. Okay, quite a bit. What's a marker of a company that actually knows how to work with startups? They probably have had a team work with the indirect procurement group to modify commercial contracts that are appropriate for pilots. They will probably have top-down managed risk, and there is also a term internally, if your business lead is savvy, they will have a better understanding of what is acceptable business risk. Okay, and that is the one. That's the term that can trump the lawyers, all right, or the attorney partners internally when you talk about, hey, this seems like acceptable business risk for what we're trying to explore, all right, because again, the legal partners are doing right by the company. You're trying to mitigate all the risk or as much risk as possible. But in some cases, how do you learn the experiment? You have to pilot these things. Sometimes you have to have a little bit of exposure, but you want to help modify this. And that's, again, where your business lead or your tech or innovation liaison can actually be quite helpful from that standpoint. Okay. So strategy, cash, and execution. I'm going to make one call on boards here. All right. And I don't have a slide for this, but boards are probably the most underutilized asset a startup founder has at their disposal. Okay. And so don't view a board as governance, view the board as an asset, and make asset of your boards, BD intros, talent introductions, other connections from that standpoint. The other fundamental piece on boards, and Matt Blumberg, who's a multi-time founder, has a couple exits. He's got a book called Startup Boards. It's a pretty interesting read. I would go and recommend it, but he has a philosophy of adding independent directors earlier on the boards than people expect. Okay. And the why around that is that independent directors often have a very objective view in terms of what the company should do. They're often bringing content or market expertise into the equation pretty quick and can be very objective without not having too much at stake as far as the investment goes. Okay. So make use of your boards. Make use of your boards from that standpoint. Good. Okay. I don't have a recap on the execution piece, but yes, so it is working with corporates. Remember the corporate context from that standpoint. Remember the decision making, and remember that tripod, and then also make use of your boards. Okay, 3. All right, foundational, and I put growth strategy, but foundational. So what is strategy? Strategy, in a very simple term, is making choices. Okay, why is that important for a startup? Because a startup has limited resources. Let's just be really honest. Okay. And there's so many startups that are pursuing stuff that they could do versus what they should do. And if you're a good founder and you're a good management team, you're going to be thinking a lot of what you should do. Okay. Not just what you could do. Now, don't get me wrong. As a startup person, you have to experiment. But make sure those are managed experiments and make sure there's discrete and there's finite timelines around those. Okay. When you come back, you really need to think about what your aim is here. Now, foundational strategy is kind of broken into 2 pieces. First one's pretty straightforward. It's where to play. And I make this analogy. Let's say you're a startup and you're like an athlete. You're 6'6", pretty athletic. You can jump high, run fast, and you can throw a ball. You can actually play a lot of different sports. Okay, but the sport you choose to compete in, okay, will define how successful you are from that standpoint. I used to have a picture of Michael Jordan here. Michael Jordan, the world's greatest basketball player, just the world's most average baseball player. Okay. So where to play as a startup founder, as a startup leader is very important for you to think about. So where do you compete? Okay. Typical things around competing, geographic piece, obviously AGP helps enable startups to compete in the US, right? But channels, online, in-store, I used to do a lot of physical stuff. Now I do more software and online. Customer segment focus. In your pitch deck, when they ask for the ICP, that's a reason because they want to know who you're really focused on. Okay. And in some cases, answers are both. What's really important is these answers are overt. These choices are overt. Okay. And everyone knows things change in the startup. So it's always kind of your best working hypothesis in terms of where to play. Okay. Where to play is pretty straightforward. The one that's a little bit tougher is how to win. So if we're going to compete in a certain domain, how do we win that domain? Here's a quick litmus test. You want to meet a startup founder, ask them to give me 3 adjectives that describe your competitive advantage. Okay. And sometimes it's faster, cheaper, better UI from that standpoint, but you should know what that is. And that gives you an indication of what you're competitive, how you're competing or choosing to compete for your company. Classic cases in my old world, price. I worked at Target. Walmart would dominate in price, right? They would do everyday low pricing. The retailer I was with, Target, they would differentiate, make things really unique, and compete as much on price. But those are classic strategies. What's another classic strategy kind of out of my old world? IKEA, again, another low cost. But here's some strategies or things they put in place to bring the strategy to life. Everything's self-serve when you go to the store. Everything's designed to be in a flat box because they're minimized shipping costs. Okay. They also buy excess capacity from manufacturers, and they do, you know what? They actually go buy wood at the tree level. Okay. And if you're like a grocer, some grocers do this. They go buy the peach farm harvest, okay, in advance. All right. And that's really important. Everyone loves to talk about Amazon. So let me talk about Amazon a little bit. Their strategy, long tail strategy. Now, here's what's interesting. Like everyone can see it, but let me tell you, in being a former retail guy, their P&L managers are not incented on sales. Okay, so they're an e-commerce player. They're not incented on sales, or at least they weren't when I did this research. And it's a little bit dated, but they're incented on the number of SKUs that they can put in the assortment, the quality of the descriptions, the amount of inventory turnover. Okay, it's surprising they're not incented actually on the direct sale. They're incented on the enablers of sales from that standpoint. Other pieces, marketplace offering. I had someone on my team actually go to Amazon from Target. He went there, and I said, "Hey, Corey, how's it going?" He's like, "You know what's super interesting? People don't care if we actually hit our sales numbers for the day, but if I can bring in a new vendor, wow, I'm getting high fives all across the floor from my manager." Okay, so this culture celebrates the signing of additional vendors from that standpoint. Here's the punchline of the strategy. You have to make your choices. Again, it's emphasize capabilities over the long term. All right, what is a capability? What is that? Very simply put, it's a recipe of people, assets, could be software, and processes that enable you to do something. All right, enable you to do something. Now, we go back to that example around IKEA. You can bet for sure they have a design team that knows how to design things in flat boxes. Okay, they probably have a product design calendar. They probably have certain cost targets and material costs that they look at. And you bring those together to really unleash this ability to provide something at a lower cost. Sound good? Okay. Foundational strategy, where to play, how to win. Think about capabilities over the long term. And you know what? If you ever want to get bought out, capabilities is what your acquirer is going to be looking at, honestly. When I would do due diligence on buying a startup for my previous employer, I would go in and I would look at the capability that was distinctive, and I try to re-engineer how long it would take us to build that. All right. Okay. One other thing, this point number 3 is longer term, operationalize your strategy. As you get bigger, what is really helpful, surprisingly, is actually something as simple as a corporate calendar, especially if there's seasonality to your business. When do things peak? When do we need to plan? How do we get ahead of things? What's challenging in a startup is that there's so much work. It's like driving in a car at night. Your headlight only goes out so far, okay? And you want to actually drive during the day where you have to have a stronger roadmap. You can see all the pieces of the road that you need to do for the year. All right. Okay. The last one is the startup leadership piece. This really has to do with people. And what I would say, I'm a little bit fortunate to have gotten some really good training at my previous employer around people leadership. And at the end of the day, your startup is a bunch of software, typically, some other assets, and a whole bunch of people. All right. So I'm a little bit surprised sometimes at how underutilized or how much training is not available on the startup leadership side. Okay. Because there's a lot of things you got to do, and you have to be a jack of all trades. You have to do a lot of things. If you're not familiar with a skill wheel matrix, I highly encourage you to take a look at it. It's foundationally one of the simplest situational leadership frameworks that I can tell you is probably something my clients and my portfolio help looks at, at least like once a month, especially when they're having issues. Okay. But the reality around startup leadership is that everyone you hire, you think is super great, but everyone goes through a learning curve. Okay. And you really need to recognize the difference between what's over delegation in startups versus directing people. Okay. And there's a major difference between the two. All right. When you're direct, you're actually probably providing specificity on things versus when you delegate, you expect the person to be able to figure that stuff out on their own. Okay. Startups often delegate, but actually there's really some really great people. If you feel like people on your team are underperforming, might actually have to be with your approach about delegating versus directing them. All right. There's other questions here around coaching and cheerleading that are incredibly important, especially if you ever pivot. Okay. And we can talk more about those, but I can tell you the headline here is good leaders adapt to situation. And we all know that startups, there's some volatility when you work in a startup from that standpoint. Good. Okay. Here's one other kind of key insight, especially for the senior most team, identifying individual preferences. So everyone has certain natural tendencies. Okay. Let me ask the group really quick. What is the most frequent contributor of friction between leaders? Okay. Just think about that. And this is a little bit of a roundabout way, but I'm going to take you there. Answer this question. What does vacation planning look like for you? All right, there's two camps here. Vacation planning, it looks like I've got an itinerary, I've got an agenda, certain things I want to accomplish. All right. People that are really maniacal might have an Excel sheet where all it looks like. Other folks are like, hey, we're going to get there and kind of figure it out. All right, let's optimize or what have you. That is the quintessential number one friction point between how friction that's created between leaders. Okay, and this is what's known as a Myers-Briggs typology around how you approach the outer world. Folks that are judging or need closure, have plans, have structure, have very strong decisiveness. Other folks are actually kind of strategic in nature and really trying to optimize, okay, the opportunity. When the structure needs and decisive needs meets the optimization person, you have massive friction, and it's probably the number one challenge I've seen. Some of the things I've done with teams is we actually do a typology, a quick survey, and we lay it out and we talk about the leadership team dynamic to see how you're skewed. Okay, I can tell you this has actually created pretty strong awareness around teams in terms of how they behave at the startup and how the culture is influenced. Okay, sense? If your team ends the meeting with, okay, so what's the next step? You're naturally migrating to the left. And the longer you're in corporate America, the more you're going to migrate to the left and be a little bit on the piece. All right. Okay. One thing that's very soft here, it is often overlooked. Highly encourage people to set up company values early on. Helps set the company culture. But also when you go recruits, helps candidates self-vet their fit. Okay. What does this company stand for? How do they operate? Obviously, they're going to talk to people. Okay. But the best growing outfits often have a clear kind of mission, vision, values, with the values piece actually being, surprisingly important. The picture on the right is actually the screenshot of values from Madison Reed. I met Amy is the partner at True Ventures, and she has built this company, and she's a total, she's tough. She's tough. I walked in and did the intro and said, Amy, how are you? And the first thing I saw all over the office were the values and big banners, and said, tell me more about that. She's like, I want everyone that comes here to know what we stand for. And if you can't align with this, that's okay. You're probably not a fit here. All right. So it really does help, as soft as it sounds, company values. Think about those. Shape them before the rest of the company shapes them for you. That would be my advice, because I've seen that happen too.
Yeah.
Okay. So start leadership, recognize individual preferences. The leaders are actually responsible for flexing their style. So think about the skill wall matrix, and then think a lot about company values from that standpoint. Okay. Let me close it out with this a little bit, because it kind of we talked about a lot of things, and we started with cash, okay, and we kind of ended with people. But those are the two primary responsibilities. Always on responsibility as CEO. Never run out of money, and always hire great people that are probably stronger than you. These will enable growth over the long term. Okay. Thanks, everyone. You can reach me here, but I'm also happy to open it up for questions. Scott, David, reaction?
Yeah. First of all, that was amazing, Gene. The vacation planning analogy especially was just fantastic. I totally love that. I got so many questions that have come in. We're not going to have time for all of them. Let me throw a few out. I'm just rewinding to the beginning. Okay, Gene? So the first, there were two questions about accelerators.
Yeah.
Largely like your kind of updated thoughts on participating in accelerators and any of the kind of any risks or any downside you've seen for participating in them.
Yeah. So my recommendation on accelerators is try to go to something that's industry or market specific versus geographic. And the why behind that is the amount of content you get for the industry specific accelerators. It's actually pretty substantial. Can be, especially earlier on. You're going to benefit a little bit earlier on. All right. The other type of accelerator or engagement program, and there's a great guy, David, that runs this at Disney, like our BD accelerator engagement programs, where you're actually kind of onboarded into a pilot. I think that's actually really effective. But again, I recommend industry-specific accelerators, and some of them tend to be equity-free, which is great. The downside, your probably most precious resource, which is actually time. Okay, you have to make sure you're managing the time there, and then you have to make sure that the content you're getting or the opportunities are worth the time you're going to spend, because they are a commitment and they do want you to engage. The one other benefit of accelerators is the cohort you build. Like, those are relationships a lot of people carry and actually are very helpful for recruiting, inside insights, investor intros, what have you. So there's some real benefit there. But I would, again, go for industry specific, be mindful of time, those ideally equity free if that's possible. So
yeah. So there were probably half a dozen questions on KPIs. You talked earlier about KPIs, having them. Just like summarizing some of these questions, like I guess they're asking, like, do they have to be financial KPIs? And do you have any kind of general guidance on the types of KPIs that investors want to see?
Yeah. The one KPI that rules them all is sales. But I will tell you, back in that spectrum I was showing, the quality of your KPIs matter the later stage you are. Okay. What's an example? When I would go to look at due diligence on a company, I would actually look at AR, repeating sales, and repeat buys versus the one-off spearfishing, one-off sales. Okay, and it gives you a different look on the view. So the quality matters later stage you go. But CAGRs, KPI, and it really varies based on the concept or industry that you're in, right? If you're a marketplace versus SaaS versus e-commerce, they're going to expect different types of CAGRs from that standpoint. And that's actually when you, again, a great conversation to have with your board, right? Ideally, someone on your board is a seasoned investor and actually will have a better sense of that too. And they tend to change. Right? SaaS multiples were going 10x last year. They're probably down to 6.5, 7, right? And so that's a great example. They change. So it's really helpful to have someone that's up to date, industry specific on the KPIs. The qualitative piece, I think that matters, especially early on. Testimonials from real consumers, especially also credentialized experts, is pretty powerful. In fact, hidden secret in the venture studio, I would use those religiously to build conviction around an idea. Okay, if you're talking to the world's foremost expert in AI and they say this is a good idea, it's probably a good idea.
Right. That's great. I got more, but David, I don't want to totally cannibalize or capitalize the conversation. Anything on your mind that you want to throw out?
Yeah, well, I'm thinking you mentioned earlier a little bit about the actual deal with the corporates, favorable terms, things like that. What other red flags would you put out for the startup in terms of, I've heard things like, they take up too much of your time and then you can't focus on other things, or they'll pull you in the wrong direction. Like what you...
Yeah, I would say get really clear around that decision-making process. And then the other insight I want to have is go talk to some of the other startups that have worked with the same company. See what that process looked like and where it ended up. What you don't want to do is get stuck in the innovation theater where you're in their kind of demo day, their experiment show box, and it kind of stops there, right? Now, helpful if you learn a lot, but ideally you're aiming for a commercial agreement at some point. So just be really honest about the probability of getting a commercial agreement based on the expectations of the corporate partner and what they would expect out of the level of service out of the startup, okay? And it'll vary. In some cases for SaaS, it's a little bit easier. Other cases where you have other channels or other assets that need to come to market, it's a little bit tougher because there's more coordination there.
So let me ask two more questions, if I can keep you past the hour. The first is a related question that asks, are you finding companies increasingly empowering their business leads and business sponsors to interact with startups? Or are you still finding that they're kind of gatekeepers like these innovation groups that are like the on-ramp to the corporation?
That's a great question. It's really company specific in the culture piece. I'll say there are companies that have experimented with the whole engagement of startups that kind of ratcheted back because they weren't seeing the big enough return. Now, having said that, I think there's a fair number of folks in some conservative industries that realize they're getting disrupted, that are continuing very open to experiment. What's the main difference? It tends to be resource-rich companies will be more open to the experimentation. Now, having said that, I know Walmart just rolled out store number 8, but I think that's a little bit of a different case from that standpoint. But what you see is that you see companies that tend to be research-rich are open to this experimentation because they realize it's not actually a huge amount of money from that standpoint.
Interesting. All right, let me try to paraphrase these last two questions and group them together because they're both around kind of your where to play, your sports analogy of where to play. I think the questions are around, are investors do investors prefer a more detailed, focused, targeted ICP that's really narrow, or is it better to kind of be broader about kind of your focus, so to make it look like there's a larger TAM, basically? Like, what's that balance like?
Yeah, let's see. From the investor standpoint, they're really caring about the market opportunity. Okay, and in your ICP, what really matters for the ICP is that you and your team know how you're building your product. Okay. What I would say is think about your ICP as a design muse, but it'll apply to other folks. All right. What's the example? When I was running strategy at Target back then, we would be maniacal about designing things for mom. But we knew single men would shop at Target too, right? But we would design for mom as the center of the muse, and there would be a natural kind of halo from that standpoint. Why do I recommend that? Because you want to have a definitive point of view on your product. All right. And if it's not selling to the person that you're designing it for, you've got a problem. Okay. What's challenging is sometimes you design for the masses, okay, and then you design for no one. All right. You want to have a perspective on that because it's very clear when you design for the masses and it's not working, you're not sure who it's not working for. And that's a challenge. So I'd encourage you to have a specific point of view on the ICP, okay, but then be open to the overall market opportunity from that. I do get leery of working with founders that say, hey, I've got these, 3 or 4 kind of, users or what have you. I'm like, who's the most important one? And who's the most likely to buy it? Okay, what I would call best case scenario testing. Go get that best case scenario testing done early, because if they don't like it, you're focused on the wrong people.
Right.
Or your product's wrong, honestly.
That's great stuff. Look, I mean, I know we're up against it, so I think I probably have to call it. But Gene, this was like really fantastic. Thank you so much for joining us today. Really appreciate it.
Great. Thanks for having me, Scott. David.
Joining us.
Anyone who wants to join, anyone who wants to reach Gene, he's Gene@haloadvice.com. Feel free to reach out. Again, you've been talking to Gene Hahn, who's the founder and principal of Halo Advisory Network. Our next call, by the way, is going to be with Mark McSpadden, who's the VP of Global Product and UX at American Express Global Business Travel. It's going to be an amazing conversation. We'll post details shortly. You can email me or David to get, or just get on our WhatsApp founders group on our website, because we'll post information about.
Follow us on LinkedIn.
There. Yeah. Again, I'm Scott Cohen from AGP Ventures. On behalf of myself and David Yahid in Israel, thanks to Gene, thanks to our co-hosts, Mass Challenge and Lion Run Consulting, and thanks to you all for joining us. Until next time, goodbye.
Thank you, everyone. Bye.